All right, welcome to the Tuesday evening money multiplier presentation on how to become your own banker. And we're going to be talking about the infinite banking concept this evening, a over 200-year-old system of taking back control of your money and solving your money problem, and something referred to as privatized banking. So we're going to go through what privatized banking is, what is the infinite banking concept, and how you can become your own banker. So if you're brand new to this, the way this works, if you're on Facebook, I'm not monitoring Facebook. So any comments you're putting on Facebook, I'm not going to see those until later on. So I'll answer those later on. But this is a live Zoom call. So we have everybody that's on the Zoom right now. So if you're on the Zoom, please put your questions in the Q&A box. And then that way we can save the chat box for responding and holding and continuing the conversation as we go here this evening. So any questions you have, put those questions in the Q&A box, and I'll be sure to answer those either as we go or at the end, depending on if they're appropriate. And yeah, Marlene, I know the Pens are out of the playoffs. Yes, yes, yes. I also saw the Rangers actually took out Carolina last night. So at least we got beat by a team that's continuing to go on in the playoffs, right? So any questions you guys have, put them in the Q&A box and we'll get that rolling. All right, so everybody can see the screen, becoming your own banker, BYOB, how to become the bank. I have no idea where that image came from, the guy throwing the money out, but it always makes me laugh, so we use that. So let's go and dive into this thing. So if you guys need me for anything, anybody has questions after this, if anybody wants to talk with me after this, all you simply have to do is shoot me a text message or an email, 561-313-6213. My email's right there on the screen as well. And what I'll do is I'll shoot you over my call calendar, my schedule link. And that way you can pick a time that works for you where we can schedule a 30-minute call where we can hop on and I can answer any specific questions you have, discuss your situation, whether this is right for you and your family, and we'll go from there. But before that call, make sure that you watch this full presentation or you watch the recording of one of these full 90-minute presentations, because on that call, I'm there to answer your questions and help you get started. I'm not there to explain all the details. This is what this 90-minute presentation is for. And this is a whole new way of looking at money and looking at banking and how your money flows. So it's very important that you start to understand this concept. And you'll see lots of people on this call right now on this Zoom that this is their 10th time, their 20th time, their 100th time watching one of these presentations. It seems like it was the same with me. Every time I watched it, I learned something new. Every time I watched it, my mind clicked a little bit more in learning how to take back control of your money and get into privatized banking. So that's what this is all about. So all of this right now, the timing could not be better. Right now, what we see going on with the global economy, with the stock market, with the real estate market, and with inflation going through the roof, this is all craziness that's happening right now out there. So every day I talk to people and, they're worried about their 401ks. They're worried about their retirement. They're worried about their investments. They know that we're on the verge of something major happening and they don't want to get stuck like in 2008 and lose everything again, or they don't want to see their 401ks drop in half. They don't want a repeat of, the dot-com bust and things like that. So, that's what we're talking to people about all day, every day. So right now, tonight, like I said, this is all about the infinite banking concept, how to take back control of your money and become the bank, become your own banker. Tomorrow, Wednesday, join us for What the F Happened podcast at 9:30 a.m. Eastern, and join us at 1 p.m. Eastern for the Wealth Webinar Wednesday. And that's where Chris and I get into more of what's going on with the markets, what policy is happening, what decisions are going on, what is happening with the technicals in the stock market, and what to expect. So we're going to dig deep into tomorrow on our Wednesday webinars. We dig deep into all of that stuff. So make sure you join us on Wednesday for all of that. Today's just going to be on the infinite banking concept, but understand and know that what we're experiencing right now, it's happened before in history, and we need to prepare ourselves because there's going to be more opportunity coming up in the next few years to really create real wealth. I'm not talking about making 10, 15% gains, annual returns on your money. That's how you slowly and steadily protect your money and keep your money moving to make more money with those 10, 12, 15% annual returns that we get in like private money lending and things like that. What I'm talking about in the next several years is buying real estate that's going to double and triple in value over the following decade. I'm talking about buying stocks that are drop in half where we're buying them for half price, where they're going to double in the coming decade. I'm talking about creating real wealth, getting in and starting a business, solving a problem. I mean, when we look at all the businesses that started after 2008, people made, these startup companies that are worth billions and sometimes trillions of dollars. That's the stuff I'm talking about, where we're taking advantage of these markets. We're not talking about taking advantage of people, we're taking advantage of markets. And that's what this is all about. So the opportunity could not be better. So right now is the time to look at, where is your money? Where is your savings? Where are your retirement accounts? And what are you already doing right now where we can reposition and understand where our money is, so we know how to position ourselves for this coming change where we can really make and create incredible wealth for our families moving forward. So that's what we're going to talk about more about tomorrow. And right now, I just want you to understand that it's coming and be ready for it. And when we look at where our money is, whether it's in cash, in savings, in business accounts, tucked away under your mattress, whatever it is, right? Or whether it's in retirement accounts already, where can we start repositioning that to where we're prepared for that? So I'm going to start teaching you that right here this evening, and then this will roll into everything else that we do with you guys. So just keep that in mind as we go. So one of the things that's been very important in my journey when it comes to money and opportunity are mentors. So I've had many mentors and coaches over the years. Brent Kessler, the founder and creator of the Money Multiplier. He's not the founder and the creator of the infinite banking concept. What we do with this concept has been around for over 200 years. And our Nelson Nash is considered the godfather of bringing that to the masses. But Brent Kessler is my mentor when it comes to the infinite banking concept and becoming your own banker. And many of you on here right now probably know Brent. If you don't, just go to themoneymultiplier.com. Brent was a chiropractor back in the day, had several chiropractic clinics. He was involved with helping other chiropractors build their practices and expand. And one day Brent realized he was almost $1 million in debt to third-party debtors. And he wanted to get out of that situation. He was making great money, but when you make great money, you end up spending a lot of money, right? So a lot of times that debt can add up. So he was able to use this method to pay down that almost $1 million in debt and set him and his family on a new financial path to true financial wealth and success. So absolutely love Brent. Talk with him almost every single day. And just an amazing human being, along with this guy right here, Chris Noggle. So I met Chris almost 4 years ago now. We hit it off immediately. When I first met Chris, you see the quote on the screen right there. It's never about your actual resources. It's about how resourceful you can be. And I just want you to think about that for a second right there, because, what I told you when I just started here was what we do is we teach people how to take back control of their money and solve their money problems. And this quote right here is very important to that, because every single one of you on this call right now, every single person that I talk to on a daily basis is in a different financial position, which means every one of your financial strategies and what you need to do moving forward to solve your money problem is different. And you could be $1 million in debt. You could be $50,000 in debt. You could have $1 million in the bank or several $1 million in the bank right now. You have a money problem. It's just the person that's $100,000 in debt and the person that has $2 million sitting in a bank right now, their money problem is different. But the strategies that we teach, these concepts that we teach, work for both of those sides of the aisle and everybody in between. And that's the beautiful thing about it, is what I'm teaching you here this evening. You're not doing anything. You're not working any harder. You're not taking on any more risk. You're not changing your lifestyle anymore necessarily. You're just changing where the money goes first. You're understanding where your money is and how to position that money to take full advantage of these strategies. And just to give you an example of that, we run something called the Private Money Club. So the Private Money Club is a community of borrowers and lenders. So it's a place where if somebody has a real estate deal that they need money for to be able to go out there and make 100 grand on that deal, but they don't have the money up front to get that thing completed. Well, you have somebody else over here on this side of the coin that has $500,000 that they need to invest in something, but they don't have the time to go out there and do a house flip, for instance. So what Private Money Club does is it pairs these two people up. So the person that needs the money has that money problem. They need money to be able to make more money. The person over here has money, but they need an investment. They need a deal so they can put their money into it so they can make more money with their money. So both people have a problem. And what we do is we connect those people to provide the solution. And it's a win-win situation. The person borrowing gets the money they need to make the money on the real estate deal. The person lending solves their problem because now they have their money working for them, making 10, 12, 15% while it's backed by a hard asset in that real estate. So the money's protected and they're able to accomplish what they want to accomplish, creating passive income. So different problems, but we're able to solve those problems by pairing those people together, and it's a win-win situation. So just keep that in mind. No matter what your situation is right now, this will work for you. The strategy might be a little bit different, but this concept will work for you. And you'll see that as we get going here. And this goes right into this. One of my favorite quotes. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so, right? Think about that for a minute. What we teach is not taught in college, is not taught on TV, on MSNBC. Jim Cramer is not teaching you guys how to do the infinite banking concept. Dave Ramsey, on contrary, tells us what we do is not the right thing to do. And he just sells term insurance, which don't get me started in that, right? So this is something that's important. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. There's so much, and these days we hear about it all the time, misinformation and disinformation and wrong information. And it's like, what do I believe? What do I listen to? Like, where do I actually go for real financial advice? It's stuff that works right now in 2022 in this crazy post-COVID world that we live in right now, where all the markets have been fed by trillions and trillions of printed dollars by the Federal Reserve and just dumped into these markets that have overinflated everything, and they're on the verge of popping right now. Inflation's running wild. So where do you go for advice? Why not listen to people that have been through it before? I mean, this is what myself and our team do on a daily basis. We study this stuff, we implement the stuff, and then what works, we teach. We've been doing this I've been in this industry for 14 years now, learning, studying, implementing, and teaching. Chris has been doing it for almost 18 years now. Brent Kessler started the Money Multiplier over 10 years ago now. We've helped thousands and thousands of clients and students across all 50 states and Canada. So we have the proven track record. I mean, you guys can Google the Money Multiplier. There's literally zero negative stuff out there about us. And that's almost impossible to do this day and age. So again, this is nothing new. It just might be new something for you. So keep an open mind as I go through this right now, and we'll talk about that as we go. And this is just a statistic right here that proves my point. If we listen to the Social Security Administration, they tell us if we take 100 Americans, 5% of those Americans will be financially secure for retirement, meaning less than 95% of people in the richest country with the most opportunity in the history of the world are actually going to be able to retire the way, the age, and the lifestyle that they want to. That's bonkers to me. So why does that happen? And we'll talk about the wealth killers and stuff like that. But at the end of the day, it's because so many people, they listen to what's always been done, right? I mean, look at this right here. These are the 6 reasons why most people are not able to retire the way that they want to. The top 3 are what we call the 3 wealth killers. And these are all strategies we teach with Money School, how to avoid this stuff, how to not let it affect your financial future. But those top 3 right there, taxes, inflation, and volatility. Think about it for a second. What do taxes always do? They always seem to do what? They always seem to go up, right? What's inflation doing right now? Inflation's running wild over 8%. Real inflation is probably over 20%, probably 25%. And all this stuff is wealth killers. It reduces your purchasing power of your dollars that you're earning. It reduces what your investments are, like all this stuff. And then volatility. Volatility is that old, oh, the stock market's always going to go up over time. Well, what if you need that money right now and the stock market drops 50% next year and you go to retire and now your 401k is gone because everything fell? That's volatility. And volatility, when we look at the drawdown effect, and if you lose 50%, you got to make like 120 some percent back just to catch back up to even and things like that. Like, this is all stuff that there's no reason to do this. We teach with Money School, like our live 3-day training that we have. We're doing a live and an in-person training 3 days in Buffalo, New York at the end of July. Join us. We're going to bring people in that are going to show you how to completely reduce your taxes almost down to nothing. Inflation, I'm going to show you that here tonight, keeping the money moving. Volatility, there's no reason. What I'm showing you right now is a place to warehouse your wealth where it's guaranteed growth. And then take back control of it instead of just blindly throwing it at the stock market and mutual funds and index funds. Take control of that money. Do things like private money lending, buy notes, do proven things that are guaranteed to grow for you, and they're backed by assets. And this is what we're talking about when I say this is how we eliminate these wealth killers from your life. But the point is, what I was just getting at before with the 95%, according to the Social Security Administration, because people listen to other people, right? So following the status quo. I mean, think about it for a second. Like when you go get a job, you're 18 years old, 22 years old, 23 years old, whatever. You're fresh out of college, fresh out of high school, fresh out of tech school, whatever it is. And you go and you start this job and you meet with the HR person and you're filling out all this paperwork. Do you want insurance? What's your, fill out your W-9. And then they say to you, and by the way, one of the benefits that we offer you is a 401k. And you're like, all right, well, what's a 401k do for me? And they say, well, a 401k is a place where you can invest money, pre-tax dollars. So we take the money from your paycheck before you pay taxes on it. So it's going to reduce your taxable income a little bit. And then you're going to put it into this account and you're going to be able to invest in stocks and mutual funds. And over time, it's going to grow. And then it's all tax deferred growth. So you don't have to pay taxes until later on. So don't even worry about that right now. And you're like, okay, well, I guess I can do that. I mean, is that what everybody does? And they're like, oh yeah, everybody gets a 401k. And then you call your family, your mom or your friend or your uncle or whoever. And they're like, oh yeah, we did a 401k. Everybody does a 401k. So you're like, all right, I'll do the 401k too. But in reality, what's a 401k? Think about it. What did I just say? You're deferring taxes. But what did I just say? What did we just agree on that taxes do every year? It seems like they're always increasing, right? Go back and look at what taxes were 50 years ago compared to what taxes are today. What's inflation? Inflation's running crazy. And if it continues to do so, we're putting our money somewhere where we can't touch it or control it or do anything with it until after we're at retirement age, 59 and a half years old. If we pull it out early, we're penalized 10%. Plus we have to pay taxes. So I can't even control it to eliminate things like volatility and inflation. And again, what if we need it when the market's down? So it's like those three things, putting our money in a 401k. Like I was just listening to an interview that Sharon Robert Kiyosaki, you guys know Rich Dad Poor Dad, Sharon Kiyosaki was talking about, Sharon Lecter was his partner, Kim Kiyosaki. I'm sorry. I was just watching an interview that Kim Kiyosaki was giving, and she was talking all about how 401ks were never meant to be true retirement vehicles and for your retirement account on your 401k. Like they weren't designed to do that. 401ks came out when there was a stock market crash and they were having a hard time getting people to buy back into the stock market. So they said, well, what if we give you these benefits where you can use your company money, your paycheck to go into it? And that's how they kind of brought people back into the stock market to get things going again. So it's like they were never even meant to be like that. And so these are all things that stop people from being successful. And there's no reason for it. You just got to find proven techniques and strategies that have been around forever that you can do it. Again, I'm not telling you to work any harder, not work any longer, not taking on any more risk. Just change where your money goes first, where you and your family are warehousing your wealth. And by making that one change, everything else will follow. Everything else will change for you. I promise you that. And that's what this is all about, because I was a financial advisor out of college. So I know this firsthand. I would tell people, well, the only way to solve your goals and your problems and retire the way that you want to is take on more risk, push back retirement, or drastically change what you're doing right now with your life, because you're going to have to save more so you can have more money in retirement. That's what I would tell people. So I can attest to this firsthand. What I'm telling you here tonight, that's the beautiful thing. It's different. I'm not telling you to work harder, take on any more risk, change your lifestyle right now. Just change where your money goes first. And that's what we're going to get into. That's what I'm going to get into right now. There's a great book. I got a great video. I'm not going to play it for you guys. It's on YouTube. It's called The Backwards Bicycle. If you're brand new to this, I want you guys to go Google this, or go on YouTube and type it in, The Backwards Bicycle. It's an 8-minute video, but it's all about mindset. And it's about how our minds are trained and programmed to think one way. So what I'm telling you here right now is that you're going to have to change that mindset a little bit. If you want to become a millionaire and become super successful, you got to start thinking like the wealthy. You got to start thinking like a successful person. So you got to change your mindset a little bit. And this video right here, The Backwards Bicycle, is just a great example of that right there. So go check that out afterwards. Now, these are 5 books that I would highly recommend. And the concept that I'm teaching you, the infinite banking concept, becoming your own banker, is taught in these books also. So check this one out. Robert Kiyosaki, again, one of my favorite authors. I have all of his books, all of his trainings. I was lucky to train with and teach with Robert Kiyosaki back in the day. I have a lot of respect for him. I love what he does and what his teaching is and what his messaging is. And he taught all about infinite banking in his book Second Chance. So check that one out. Tony Robbins taught all about this concept in his book Money Master the Game. I think it was chapter 4 or 5. I forget exactly, but check that one out. This right here, Becoming Your Own Banker by R. Nelson Nash. It's a game changer. You guys got to go get that book. You can get it on Amazon or on the Infinite Banking website. But R. Nelson Nash was basically like the godfather of infinite banking, and really was able to bring it to the masses and teach people that it doesn't matter if you're a 20-year-old college kid or if you're 60 years old, anybody can use this concept to improve their financial future moving forward. So definitely check out that book. And then Chris and Brent wrote kind of an updated version of Becoming Your Own Banker. They named it Mapping Out the Millionaire Mystery. And that's a really, really powerful book as well. So we'll actually send you that book, like a physical copy of it, for free. All you have to do is pay shipping. Or if you guys want, I'll send you a free digital copy of it just for being here right now. Would you guys like that? Would you like if I sent you a free digital copy of that, as well as the other book that Chris wrote, The Private Money Guide? I can send you guys digital copies of both of these books just for being here if you guys want. So do this. Email me. I'll put it in the chat box. So email me or text me that you guys want a copy of those books. And what I'll do is I'll send you a digital copy of those books. And I will also send you my link, my calendar schedule link, so we can schedule a call and talk about your personal situation and finances, and just, figure out what the right plan is for you to take advantage of all this moving forward. So Pratik, I'm not writing that down right now. You need to email or text me your email and name, and I'll send it to you after this. Okay. So if you guys do that and you guys like that idea, just send that over and I will do that for you. All right. So once again, my name is Stephen Nagy. I work very closely with Chris and Brent and everything that we do with the Money Multiplier and the Money School. I was a former financial advisor with Ameriprise Financial, fully licensed, Series 7, Series 66, Florida 215 variable annuity insurance licenses. I was on my way to becoming certified financially planned and all of that. And after doing it for a couple of years, I learned about real estate investing and entrepreneurship, and my career completely changed. I started getting into real estate. I started learning more about entrepreneurship and all of this stuff that I'm sharing with you here this evening. And I made a hard decision in life, but I decided to let my financial licenses expire and let them go at the point of no return, where I said, I'm going to be an investor, an entrepreneur, and I'm going to do my own thing, or I'm going to go bust. And so 14, 15 years later, I've now been able to do that. Of course, like all entrepreneurs, I've had my ups and downs. I've had my wins and losses, but I've always taken what I've learned and applied it to future endeavors. And it's allowed me to really create some nice success. So I do live down here in South Florida now with my wife and my son, who's now 6 years old. So all three of us are now doing practicing what I preach. And we're all three now have policies, and we're all doing banking. Even my 6-year-old son has his own banking policy now that we use for little things. And more importantly, I'll teach him as he gets a little bit older, and we'll use it to buy his first car, and we'll use it for some college stuff and things like that later on. But right now we use it for fun little things here and there, because I'm already starting to teach him, hey, this is how money works. There's nothing to worry about when it comes to money. You don't have to be scared of money and things like that. So we do travel all across the country. So if you're on here right now and you have like a real estate investment association group or a meetup group, or, maybe you have a following of people, things like that, let us know. And what we'll do is we'll hop in the private airplane, or we'll fly commercial out to you, and, we'll hold an event for you and your group, or we can do a Zoom or something like that. So let us know. We love to share this stuff with other people. So that's what we do all day, every day now, as well as continuing to invest in our own things. And that's what it's all about. My wife and I are actually purchasing a new business right now. So always looking for new businesses, new investments, new deals that I can invest in personally and continue to grow myself as I share this stuff and help other people grow as well. That's what it's all about, win-win situations. All right. So like I've been saying, there's no reason for there to be mysteries behind money. I think it's one of those things where, back in the day, it was kind of like a no-no to ask people about how much money they make, what they invest in, stuff like that. To me, it's like, why would you not ask people? Like if you see somebody that you look up to, or they're doing very, very well, why would you not go chat with them? Hey, like, how did you become so successful? There's this guy on Instagram and TikTok and those things. I think his name's Daniel Mack. But he goes up to people in nice cars and he's like, hey, nice car. What do you do for a living? And he like catches them off guard. But listening to those responses, it seems like they're always either real estate investors, business owners, or they have some kind of, like internet, like they do social media, or, one of those types of things. But it's an interesting Instagram page just to kind of see that. So why not go talk to people? A lot of what we teach, I mean, one of the guys that I really look up to, his name is Greg. He started out by learning about self-directed retirement accounts, and then he would go around to people that he knew, and he's like, hey, how would you like to grow your money at 12% returns, completely 100% protected by this $1 million piece of real estate over here, where if you don't get the 12% returns, you assume control of the piece of real estate and you're going to make 50% return on your money, or whatever it is. And he went around and he taught people how to use their retirement accounts to do those types of investments. And then he grew it into his own company and has made literally tens, if not hundreds of millions of dollars at this point, done thousands of real estate transactions, and just is a super successful person just by going teaching other people that he knew how to take back control of their money. So to me, there's no reason that money should be a mystery. And at the end of the day, what is money? What is money? I mean, at the end of the day, money is just simply a means of exchange. I trade you this dollar bill for this service, or I trade you this stack of dollar bills for this product, or, it doesn't have to be dollar bills. I trade you this cryptocurrency, or this gold and silver, or this precious metal. I mean, that's all money is. Money is simply a means of exchange, period. So when it comes to compounding interest, I'm going to talk a lot about that tonight. Something ironic is no companies in this country actually use compounding interest. Pretty bizarre. Banks will use your money to compound and make more money, but no companies actually use compounding interest. We talked about this stuff. Taxes are always going up. Your dollar's worth more then than it is now. Why are we putting our money in 401ks? For no reason. So how much do you really know about that retirement account? And, there's so many people that I talk to that are like, we're putting 15% of our income into the 401k pre-tax dollars. It's like, why are you doing that? Your company's only matching you up to 6%. If your company matches you, I get it, right? Put in up to the match, but anything more, That's stuff that we need to start thinking about. Where is our money going right now? Where are we saving? How much are we putting into 401ks? How much are we putting into other retirement accounts? How much are we putting into savings accounts? How much are we putting under our mattress? How much are we investing right now into real estate from our savings accounts, not into our own private banking account? How much money is going to other people in interest that I'll talk about in just a second, things like that. So we need to understand where our money is now, so we understand how to fully take advantage of different laws and strategies to increase our wealth without working any harder, any longer, and taking on any more risk. So let me ask you this question. Put this in the comment box. Can you make money earning 4% while paying 6%? Only if you're new on here. Only answer if you're new. So if you're new to this training webinar, answer this in the comment box. Yes or no. Can you make money earning 4% while paying 6%? What do you guys think? Yeah, Tess. I don't want you ruining it for everybody else. All right. So Roni says yes. So Roni, you think you can make money paying 6%, but only owning 4%? What do you guys think? Pratik's confused. That's okay. That's okay. Well, let me give you an example here. All right. Felipe says no. All right. Let me give you an example here. Let's say you want to buy a new car and that car is $25,000. So you have $25,000 at the bank right now at Wells Fargo, and it's sitting in a savings account, right? So you go to your bank to withdraw the $25,000, and the banker says, hold on a second. Instead of withdrawing that $25,000 to go purchase that new car, what if we let the $25,000 remain in your savings account, and we're going to pay you 4% on your money that's sitting in that savings account? Okay. Now, of course, this is a magic savings account because no actual traditional banks offer 4% in a savings account right now, but let's just pretend. So the Mr. Banker says to you, I'm going to let your money sit in that savings account, earning 4% annually, and we'll use that money as collateral, and I will give you a loan for $25,000 so you can go purchase that new car. And you say, okay, well, I can do that. Well, how much am I going to have to pay for that loan? And Mr. Banker says, well, you're going to pay 6% annually on that car note that we give you for 5 years, 6% annually for 5 years. And you say, all right, Mr. Banker, well, I knew there was a catch, because why the hell would I pay you 6% when you're only paying me 4% on my money? That's how banks get rich. You're going to make money off of my money because I'm paying more than what you're paying me for my money, right? That's what most people would think. And that makes sense. Why would I pay 6% when you're only giving me 4%? Well, check this out right here. This is the difference in compounding interest versus a depreciating payment. All right. Because what happens when we make a car payment? The balance of that car note starts at $25,000. But each time we make a monthly payment of $483, it's reducing the balance of that car note. So over 5 years, even though you're paying 6% annually, the amount you're paying each year is a little bit less, is less and less and less and less. So at the end of the 5 years, you end up paying an additional about $4,000. So the total amount paid, that 25 plus the interest, is right at $29,000. But think about what the money over there in your savings account is doing. The money over there is compounding at 4%, and it's increasing each year. So each year, even though you're compounding at a lower interest rate than what you're paying on that car loan, your money ends up compounding to just over $30,500. So right there, this is just simple math. You guys can do this with a compound calculator. You go to bankrate.com and get one of these calculators and do it yourself. But right there, by $25,000 over 5 years, by earning 4% while paying 6%, we just made over $1,500 right there. Does that make sense to you guys? So that's why, going back to what we talked about with the backwards bicycle and starting to realize this stuff that, just because we look at something one way and we're convinced that it's right, a lot of times there's little things that we forgot to take into account. And I know that a traditional bank account doesn't offer 4%, but guess what? When you own your own bank, my bank does pay me over 4% for the money that's sitting in my account. And not only that, even when I'm using that money to do things like buy cars, to do things like buy more real estate, to do things like buy new businesses, that money remains in my bank, compounding and growing for me over that amount year after year after year for the rest of my life. And that's what's called uninterrupted compounding interest. And that right there, while simultaneously being able to use the money for other things, is what the infinite banking concept is all about. So that's what this is about right here. This is the money multiplier method. So follow me. The money multiplier method consists of 3 parts. And this is what I'm going to go over with you for the rest of the time that we have here this evening. These 3 parts are what's going to make up the infinite banking concept and make all of this work for you the way that I just showed you. So number 1 is the machine. I'll show you a look under the hood of this machine in just a second. Number 2 is the marathon. Let me make this very, very clear. Becoming your own banker is not, winning the lottery overnight. It's not going out there and saying, okay, I'm going to put $10,000 into this machine and I'm going to make $1 million in the next week. No, but you put money into this machine and you follow what we teach you how to do, you will become a millionaire. And not only will you become a millionaire, but you will set your family up guaranteed to become millionaires down the road. I can promise you that, because it's all contractual and it's all guaranteed. So just because it's not a get rich quick scheme, you use this machine and you go through this marathon with us and you will become the millionaire, which is the 3rd part of this entire thing. Do you guys like the sound of that right there? Is everybody following me so far? All right. So let's get into this. What is this machine? Okay. Let's take a look at what this machine is. This machine is nothing more than a dividend paying whole life insurance policy from a mutually owned insurance company. That's right. So what we're using here to become our own bank and flow our money through to be able to do all of this is a whole life insurance policy. That's it, plain and simple, guys. Now, let me clarify. This is not a whole life insurance policy that you're going to call your buddy or your brother-in-law, your uncle, or somebody like that. Everybody knows somebody that sells life insurance, right? This is not that at all. This is a specially designed and engineered whole life policy specifically built for the infinite banking concept. This is what we do at the Money Multiplier all day, every day. So if you call me, you get on, like I said, email or text me, and I'll send you my call calendar, schedule a call. When we talk, I'm not going to talk to you about an IUL. No, you bring up IUL to me, we're going to have a serious conversation. I'm not going to sell you a term policy. I'm not going to sell you some policy that's full of a bunch of riders that cost a bunch of money, that make me a bunch of money. I'm going to build you a banking policy, period. Okay. That's it. That's all we do all day, every single day. We work with several insurance companies, American United Life, Mass Mutual, Lafayette Life Insurance Company, Guardian. So we work with all these different insurance companies that fit your needs, but I'm going to build you a specially designed and engineered whole life policy. Okay. There's a lot more that goes into this. And this is specifically going to be for banking purposes, where you put money in and immediately within 30 days, you're pulling money back out of this thing. And I'll show you the details on this as we go. I just wanted to clarify, though, this is not some just policy off the shelf. Now, why do we use a whole life insurance policy from a mutually owned dividend paying insurance company as the vehicle? Why is that the machine that we use for the infinite banking concept? Why? Well, the answer to that is very simple. It's because that vehicle right there, that machine, is the only vehicle that the IRS and the government allows us to use to be able to do what this thing does, which means it's the only vehicle that we can put our money in and get uninterrupted, guaranteed, tax-free compounding interest for the rest of our lives. that I mentioned tax-free, the money that goes into this thing, all that growth inside that for the rest of your life is tax-free. When you pull the money out to use it, it comes out in the form of a loan. So it's tax-free. It's not reported anywhere. Nobody even knows you're taking the money out. I could have $500,000 in my whole life policy. I take a $500,000 loan. Nobody even knows I have it. It's tax-free. It's not reported anywhere. And finally, once you do pass, because it is life insurance, your beneficiaries will get a death benefit from this thing. And that also will be tax-free. So it's the only vehicle that the government and the IRS allows us to put money in, take advantage of all of this stuff that I'm telling you right now. It's the only vehicle. So that's why this is the machine, plain and simple. You guys find me something better than a whole life policy to be able to do this with? I'm all ears. It doesn't exist in the United States of America. So just to clarify that right there. And we're not the only ones that use this. Check this out. You guys go check, you guys go look this up afterwards. Type in BOLI, Google BOLI, Google BOLI, bank-owned life insurance. Did you know that banks are the #1 purchasers of whole life insurance in this country? When it comes to banks' assets and their M1 money supply, do you know what banks invest in? Two things. Banks put their money in whole life insurance, #1. And #2, banks put their money in real estate. Think about that. What do we do with our money? This is what I'm telling you right now. If you guys follow us on our webinars and follow our trainings and go on YouTube and hop on these, we tell you, what do we talk about? Whole life, the infinite banking concept, and real estate investing. And we talk about other things too, but that's primarily it. If the banks do it, if the extremely wealthy do it, that's what we're going to do too. Do you guys like the sound of that? So go check that out, BOLI, bank-owned life insurance, and you can verify all this stuff that I'm telling you. Don't take my word for it. So who else uses these policies for their families, for their businesses? Well, how about Jim Harbaugh? You guys know Jim Harbaugh? Jim Harbaugh is a football coach for the Michigan Wolverines college football team. This right here, check this out. Cash value life insurance makes Harbaugh college football's top paid coach. This was from November of 2016. This type of deferred compensation alternative appeals to talented leaders and executives. And it goes on to talk a little bit about it. So check that one out. Google that one. #2, Joe Biden, President of the United States. Joe Biden has some investments, but Biden also holds 4 checking accounts, 2 of which he shares with his wife. In addition, he holds 6 life insurance policies with Mass Mutual, one of the companies that we do business with. The Biden's reported adjustable gross income, so he's using these policies to store and warehouse wealth. Disneyland. Walt Disney wanted to start Disneyland, but after failing in this pursuit of traditional means of financing to build what would become Disneyland, Walt decided to provide his own financing. A large part of this came to be by collaterally borrowing money from his cash value whole life insurance policies. So Disney World might have not even been here if it wasn't for being able to use these policies that way. Pampered Chef, using $3,000 she borrowed from a life insurance policy. Home economist Doris Christopher started the Pampered Chef in her suburban home in 1980. By 2002, the company had grown into $700 million operation that was acquired by Warren Buffett for $1.5 billion. Today, the company boasts 12 million customers. Ray Kroc and McDonald's. Check that one out. Ray Kroc partnered with McDonald Brothers and opened his first McDonald's in 1955. In 61, he bought out the brothers. Kroc did not take a salary for the first 8 years, and to help with cash flow, he borrowed money from 2 cash value life insurance policies to help cover salaries of his key employees, as well as some of the wealthiest families like the JPs, the Morgans, the Chases, the Vanderbilts, and the Rockefellers. And you can read all about this stuff, you guys. Check it out. There's been books written about this, but this concept is nothing new. It might be new for you right now, but it's been being practiced and used for over 200 years in this country. The oil tycoons back in the 80s were putting billions of dollars into these policies. And that's when the IRS came out and came up with some regulations, something called the MEC regulation, which when we build a policy, we have to design it around those regulations and things. But just because it's regulated, they still give us the ability to be able to do everything that I'm talking about here right now with you. So to fully understand this concept, we need to understand how money moves a little bit more, okay? So a lot of what we teach you with using this concept, we're going to operate as something called the spread. So the spread is the money you're making when you make an investment for what you pay for that money. We keep the spread, which is the profit. So this is what banks do with your money. So again, we're just mimicking what the wealthy do. We're mimicking what the banks do, because banks know how to make money. So check this out. If you had $100,000 and you went down to your bank and you gave it to the bank, you guys realize they don't just take that money and stick it in like a safe deposit box with your name on it, right? You don't, when you go and you deposit money and then withdraw it, you're not getting back your same dollars. They take your money and they immediately put that money to work. So you take that $100,000. And again, these interest rates are kind of irrelevant. It's just all we're looking at is the spread, right? So they pay you 4% in this magic savings account, right? But so you put the money in the bank, and then they take that money, and then you go and, somebody goes to the bank and they say, well, we need a home loan. Okay, we'll give you a mortgage. We'll charge you 7% of that mortgage. So the bank, you take the money, you give it to the sellers. What do the sellers do? They put it right back in the bank. Then let's say you need a new car. So you go down to the bank and you get a car note, 8%. Go to the car dealer. They take the money, they put it right back in the bank. Now you need to remodel your new house, right? Put in a pool or redo the kitchen or whatever. So you get a home remodel loan, take that money, give it to the contractor. A few years go by. Now you got a little bit of debt, right? You accumulate a little bit of debt or whatever the case might be. So you go to the bank, they give you a debt consolidation loan. You pay off those credit cards. They put that money right back in the bank. So what did the bank do right there? Well, first off, they're paying you 4%. They charge 7% for that home loan. So they just made 3% off of the money right there. For the new car loan, they made 4% spread right there. For the home remodel loan, they made 5% spread right there. For the debt consolidation loan, they made 8% off your money right there. Again, they're just working off the spread, right? So they just made a total of, how much is that if we add it up? They just made a total of 20% off of the money that you gave them in your savings account sitting at the bank, right? Do you guys agree with that? 20%, is that number right? Wrong. Check this out. That money that you have sitting in the bank, think about this for a second. They're paying you 4%. They just made 20% off of that money. So what did they just make? They just made a 500% return, 5 times the money. They just made a 500% return on the money that you left sitting in that bank. And again, don't take my word for this. You guys go to Bauer Financial, BAUER financial.com, BauerFinancial.com, and they research banks and they have all the details on how banks operate and the money banks make and all that stuff. And they tell you right there, banks make between 400 and 1,300% on money that you leave there. So why are you leaving your money at the bank, allowing the bank to make all of this money off of your money when they're paying you right now 0.1% in a savings account, under 1% in a savings account? Why are you letting the banks? Why aren't you the one being the bank? Because think about it for a second. If you owned a hair salon, where would you go get your hair cut? Or if you owned a restaurant and you had friends in town, where would you take your friends to eat? At your restaurant, right? Or if you own a gym, I mean, if you ever known anybody that owns a gym, the gym owner is always in that gym working out themselves, because why would you go elsewhere? Well, if you owned your own bank, where would you go to do your banking? At your own bank, right? So why haven't you set up your own bank yet? Probably because you just never learned this before. You've never been taught how to do it before. So we're taking this to where every single one of you on here right now can now start your own bank, where you can warehouse your money in your bank, where you're making these returns. You're growing your wealth and for your family, instead of making all that money for the banks and the finance companies and everybody else out there making them rich. Let's make you and your family rich. Do you guys like the idea of that right there? So this is how we start doing this. Let me start showing you how this marathon starts to work, okay? So first we need to see, where is our money going? This is how the marathon starts to work. Where is our money going right now? So on average, the annual pattern of spending for people in this country, on average, 20%, 20 cents of every dollar that you make is going to go towards an automobile, whether that's purchasing it, whether that's payments, whether that's gas, upkeep, maintenance, insurance. 20 cents of every dollar you make on average in this country goes towards an automobile. 30% of every dollar that you make in this country is going to go towards housing, whether that's a mortgage, rent, insurance, maintenance, taxes, whatever the case might be. 30 cents of every dollar goes to housing. 40 cents of every dollar goes to everything else. So travel, food, entertainment, kids, whatever the case might be, which leaves 10% on average goes towards savings. And actually that savings number right now, I've been seeing some reports coming out, that savings number is actually drastically dropping right now. So it's actually a lot less than 10%. But on average, we'll just say that 10% goes towards savings, only 10%, which means 90% of every dollar you make is going to everybody else out there. So part of the marathon and the infinite banking concept is changing. Instead of giving that money to everybody else, we want to keep that money in our own financial lives. So let me show you this. Let's build this backwards now. So let's start with that same 10 cents in savings, but let's look at that automobile. So of that 20 cents that goes towards your car, on average, 5 cents of that 20 cents is going towards interest. Okay. And even if you pay cash for a car, what are you giving up if you pay cash? You're giving up opportunity costs for what that money could be doing. So one way or another, you're losing on this right here. But on average, most people are going to finance a car, and 5 cents of that 20 cents is going towards interest. So all we're going to do is we're going to recapture that interest. So instead of giving that 5 cents of every 20 cents to someone else's bank or finance company, we're going to pay it back to our bank. So by recapturing that interest that we were giving to other people and putting it into our bank, all we're doing is putting it into our savings. So we're going to take that 5 cents and put it back into our savings, our bank. So what did that do right there? Well, it increased our savings by doing that one thing right there by 50%. Because if we were saving 10% before and we just increased another 5 cents up to 15, we just increased our savings by 50% by just recapturing automobiles. And I'll show you in a second how to get back every single dollar using this for every car you'll ever buy, drive, and own in the future. I'll show you that next. But right now, we're just taking back that money and putting it in our savings. Well, get this. Of the 30 cents of every dollar that you make that goes towards housing, get this. On average, 25 cents of that 30 cents goes to interest. Why? Because banks know how to make money. Did you know that your mortgage, if you get a 30-year fixed mortgage, over 90% of the interest paid on that 30-year mortgage is paid in the first 7 years? Did you know that over 90% of people in this country refinance or purchase a new home on average every 7 years? So think about that. Why do the banks always go through these cycles of housing prices, of interest rates? Because they want you to refinance every 7 years. They want you to sell your home and buy a new home every 7 years. On average, it happens because they know they're going to get over 90% of their money in interest in those first 7 years. So let's stop that right there. Let's recapture that 25 cents back into our bank, into our savings. And I'll show you how to do that in just a second. When I show you after how to pay for all the cars you're ever going to buy, I'll show you how to start eliminating debt. And instead of giving all this interest to other people, we bring it back into our financial lives for our families. So that's going to go back into our savings. And then of the 40 cents that goes to everything else, on average, 5 cents of that goes to banks. Now, when we start getting into higher credit card debt in this country and things like that, a little bit more than that 5 cents is going to start going to credit card companies. So it increases, but on average, 5 cents of that 40 cents. So we're going to recapture that 5 cents back as well. So we didn't change anything right here. All we change is where the money goes. Instead of to other people's banks, it's going to our banks. We're not working any harder. We're not working any longer. We're not taking on any more risk, but we're able to increase our savings from 10% to 5, 10, 25, 35, 4 to like 45 cents of every dollar. So from 10 to 45 without doing anything different. Do you guys like that right there? Plain and simple. It's not hard. It's just changing where that money flows first. All right. Now let's get into talking about this car, how to pay for every car you'll ever buy, drive, and own. And before we get into that, let's pull back the onion a little bit. Let's look at this vehicle. Let's look at this machine, this whole life machine that we use. So over on the right here, let's take a look under this whole life policy. So this is what we call a money multiplier mapping illustration. So right here, this is the policy year, the whole life policy year, the age of the person, how much they're putting into the policy each year. Now, this policy right here has $10,000 a year going into it. The amount of money that you put into your policy, your banking system, is up to you. I'll never tell you how much. I'll never tell you to put 10,000 a year in, 5,000 a year in, 20,000 a year in, $100,000 a year. I'll never tell you. That's up to you. I'll talk to you about what works for your financial situation and help you strategize, but you're going to tell me. And we don't care how much. You know, as a guideline minimum, we'll tell you to put in at least 10 times your age on a monthly basis. So if you're 30 years old, put in at least $300 a month. If you're 50 years old, put in at least $500 a month. But that amount or more is completely up to you. And whether you pay in monthly, quarterly, biannually, or all up front each year, that's completely up to you as well. So this guy right here, this $10,000 a year, they could have put 10,000 in all up front, 5,000 twice a year, 2,500 quarterly, or 833 a month. It's up to them. But we're going to build it around that annual number for you, whatever that number is. So this is on this example over here. This is what this illustration is. And then what we did is we said, okay, in the third year of this policy, they wanted to buy a $25,000 car. And I'll get into the details of this in just a second. So the cash value is the amount of money you have to pull loans out. And the death benefit is how much if you were to pass away or graduate, as Brent and Chris like to say. If you were to pass, the death benefit is how much is paid out tax-free to your beneficiaries. So this is a little look under the hood of what this machine looks like, okay? Now let's talk about it. Something that I want you guys to start thinking about here. These premiums that are going into this policy each month or each year, I want you to start thinking about them as deposits. Because think about it. If you have a term insurance, life insurance policy, well, yeah, that money you're putting out each month is a premium, something that you have to do, right? It becomes a liability. Well, when you put money into this policy, this is money you're now putting into your new banking system. So if you go down to your local Wells Fargo with a chunk of change, you're excited about going down to deposit into their bank. So why would you not be excited about going and depositing into your own bank? And you will be. It just takes that mindset shift to understand it's not a premium. It's not something you have to do. It's a deposit. It's something that you want to do. And as soon as you start doing it and actually doing infinite banking, that'll click for you and you'll understand it. And then you're going to want to know how much more deposits, how many deposits can I get into this thing? But at the beginning, it's a little hard for you to wrap your mind around this is what I see with people that are newer to this. So I want you to start thinking about that right now. These are deposits, not premiums. Again, the age doesn't matter. It could affect, how much you're putting into, like I said, a 30-year-old, 300 or more, 50-year-old, 500 or more, something like that. But at the end of the day, I mean, I started a month for my policy for my when he was 5 years old last year. Chris started a policy for his daughter when she was 6 months old. People start them with their kids all the time. And we do policies with people in their 70s that are in good health. And if you're not in great health, or you're older in your 80s or something like that, or whatever reason, we do have solutions for that as well. So just let me know if you don't fit into that or this doesn't work. And we do have solutions on how you can do it on other people's lives and things like that also. So no worries there at all. I just wanted to kind of give you a look under the hood of that thing. All right. So let's look at this for buying vehicles. So this is that same policy right there. They put $10,000 in, the cash value grows. So in the third year of this policy, they want to go ahead and buy a car. So they take a loan from the policy for $25,000. And then what we do is our mapping team is going to map this out for you. So they're going to create a recapture structure for getting the money back into the policy when you take the loan out. Now, you don't have to repay loans. It's completely up to you. but you want to be an honest banker, right? And I'll talk about this as we go here right now. But at the end of the day, what they did is they pulled the 25,000 out. They paid themselves back with interest, just like you would pay a bank back with interest. So $6,000 a year, and we did it over 5 years, which is pretty common for a car note. So at the end of the 7 years, they put $70,000 into this policy. They paid themselves back $30,000, that $25,000 with interest. So they were able at the end of those 7 years to put $75,000 into this banking system after we account for taking the money out. Now, we put $75,000 in. We now have $67,000 available to pull back out for the next loan. And we have the $25,000 car that we purchased sitting in our driveway. So we were able to recapture 91 cents of every dollar that we put into this vehicle, put into this policy. And we have the vehicle free and clear sitting in our driveway paid for. Okay. So I know we didn't recapture 100%. We recaptured 91% right here. But keep in mind, this policy doesn't stop after 7 years. And now we have $68,000 sitting there to do what with? To go and buy another car or go and do something else with it, right? So in this case, like most people, once you've had a car for 3, 4, 5 years, you want a new one. It loses the new car smell, whatever reason. A lot of people feel good buying new cars every several years. So what we do in the 8th year of this policy is we stop putting money into it. Now, realistically, you would never want to stop depositing money into your own bank, right? But to prove this, to show you how this works, in this example, we're going to stop putting money into this policy after the 7th year. So no more premium deposits go into this thing. We take another $25,000 loan out of the policy from that $67,000. And then once again, we're an honest banker, so we pay ourselves back. So over the next 5 years, we put no new deposits in. We did put $30,000 of recaptured payments in, and we took $25,000 out to purchase that car. So we put an additional $5,000 into the policy, but look what happened right there. Our policy grew from $67,800 to $91,473. We only put $5,000 gross into that policy, or excuse me, net into that policy. And our policy grew by over $23,000, even though we only put $5,000 into it. So what this tells me is I have $91,000 sitting in my policy right now. I have two vehicles that I paid $50,000 for sitting in my driveway right now. So if I have two $50,000 purchases and I have $91,000 sitting in my account ready to go, well, that tells me I've recaptured all that money that I used to pay for those vehicles in the first place. And guess what, guys? If this works for a car, what else does it work for? But we have to follow the 3 rules, okay? So let me show you those 3 rules. For this concept to work, we got to follow the 3 rules, and then I'll point a couple of little caveats out. So number 1, you always want to pay yourself first, okay? So we always want to make sure we're making those premium deposits into our bank. Number 2, you always want to pay yourself with interest. Think about it. If you go to Wells Fargo and borrow money for something, they're going to charge you interest. If you go and finance something, they're going to charge you interest. So if you go to your own bank to borrow money to buy something, what are you going to do? You're going to charge yourself interest, right? However, here's the difference. If I go to Ally or Wells Fargo or Chase Bank and get a car loan, and then in 2 years from now, I run into some financial troubles and I can't make that car loan repayment, what is Wells Fargo or Ally Bank going to do? They're going to send their tow truck driver to my house. They're going to hook my car up to their tow truck and they're going to haul it away. Now, they're not breaking the law. They're not stealing my car. They're not doing grand theft auto. They're repossessing it because I had a contract in place that said, if I don't pay that car note, you guys have the right to come take it away from me. I have no say in that. I can't say, listen, I lost my job. Listen, COVID happened. Listen, I got divorced. They don't give a shit. You don't pay them, they're going to come take that thing from you. Now, let me ask you this. I borrowed the money from my own bank, Bank of Snaky, right? And then all of a sudden, in a couple of years, I can't make my car payment for whatever reason. Well, I'm going to go to myself. I'm going to say, hey, Bank of Snaky, I ran into some financial trouble. I can't make the car payment right now. Do you mind if I wait 6 months? Or if I wait a year, take a year off, and I'll continue in payments next year? Well, I'm going to say to myself, I'm going to say, okay, well, yeah, know what? You've been a good borrower. I kind of like you, Mr. Stephen Nagy. I kind of like you, right? I'll go ahead and give you some leniency. I won't repossess your vehicle, and I will, let you resume payments next year, right? You're in charge. You're the banker. So I'm kind of joking around a little bit there, but that's what happens. You're the banker. You're in charge. You set the rules. Whatever the terms are, that's completely up to you. If you want to repo your own vehicle, go ahead. I would recommend giving yourself and cutting yourself a break, right? But that's the bottom line, is you're in charge. You set the terms. You have control. And rule number 3, when it comes to infinite banking, always recycle and recapture your money. So again, that's keeping the interest within your family. Instead of financing stuff and giving all that interest to other people, let's keep that within our financial lives and let our wealth grow for our families into the future. And again, if this works for a car, what else does it work for? Airplanes, purchases, college, a business, real estate. The list is literally infinite. It goes on and on and on and on. All right. Now, like I said before, one of the other things when we start recapturing our wealth and not give it to other people while continuing to build wealth and paying off debt even quicker are what we do with people that have debt. Okay. So if you're on here right now and you have a little bit of debt, no matter what it is, it doesn't matter what kind, credit cards, student loans, mortgages, whatever the case might be, let me show you what we do with every single one of our clients. We're going to create for you what's called a debt map. All right. So this is how this works. So this is an actual client of ours. This was a chiropractor that Brent worked with. Guy made great money, but he also spent a lot of money. And all of a sudden, one day he realized that he was $478 in third-party debt. And this is how it all broke down right here. And he realized that if he was to pay off all this debt as planned, it would take him a total of 19 years. He was paying $5,777 a month. If we add up all these monthly payments, almost $70,000 a year, he was making payments to other people's banks. So we said, all right, well, let me show you how to use this policy and the infinite banking concept to recapture that interest while building wealth and paying off this debt a lot faster than 19 years. Do you guys like the sound of that right there? So let me show you exactly what we did to accomplish this. So this chiropractor started a policy and he wanted to put $25,000 a year into this policy. So in year number 1, he put $25,000 in. Now the cash value, which is the amount that you have to take loans from, was a little under $15,000. So yes, guys, in the first couple of years, the money that you're putting into this policy, the amount available to use is going to be a little bit less. But remember, this is a marathon. So at some point, this is going to catch up to where after the first few years, every dollar you put in, you now are pulling more than $1 back out. And because of uninterrupted compounding interest, the amount available that it grows each year as you put money in is more and more and more and more and more and more. Okay. But in the early years, in the first few years, it's going to be a little bit less. Now, the policies we design now, we can build very high cash value where instead of 15,000, they might have 20,000, 22,000 of that 25 available right away. Again, when I say right away, immediately within 30 days to pull it right back out. But nonetheless, this policy right here, $25,000 went in. They had 15,000 immediately to pull back out. So that's exactly what we did. We pulled that $15,000 out. We immediately paid off the Discover card and the Lowe's card and paid down the Nordstrom card. So what this did right here is that eliminated the $161 payment and the $287 payment for a total of $448. So what does that mean? That means now that we have $5,329 going to other people, and we have $448 that we now are not giving to other people. So what are we going to do with that $448 a month? Well, remember the rules. We're going to recycle and recapture that money back to our financial lives. So instead of giving that $448 to Lowe's and Discover Card, we're now going to give that $448 to the Bank of Stephen Nagy. So each month, that 448 is going to come back to me, and it's going to build up in what we call a segregated bank account. So when we teach you how to start doing banking with our mapping team, we're going to recommend you open up what's called a segregated bank account, otherwise known as just a separate checking account. This is a checking account that you're just going to use for accounting purposes and for tracking everything you're doing with banking, okay, with the money multiplier. So when you take the loan out, the money's going to get deployed from into the loan goes into the segregated account, from the segregated account to pay off the debt. And then as we recapture that money, it goes back into the segregated account. So then we can use it over and over and over again. And I'll show you that as we go here. So for 5,300 going to other people, 448 going back to ourselves. Year 2, 25,000 goes into the policy. Now in year 2, they have 16,500 available. You'll see each year it goes up a little bit more. And then the recapture payments. So that was that 448 a month that we're recapturing back to our segregated bank account, added up to 5,300. So now we have a total of 22,000 that we can deploy out to tackle more debt. So we take that 22,000, we pay off the Nordstrom, we pay off the Wells Fargo, and we pay off the private loan, and we reduce the BMW payment a little bit. Okay. Now we have $1,900 in payments that we eliminated that are now going back to our bank, and only $3,800 a month going to other people's banks. Year 3, same thing. 25 goes in, policy grows by a little over 25,000. We have recaptured payments of 23,000, total cash of 48,000 to pay off the BMW, the West Marine card, and pay down the condo a little bit. $1,900, $3,677 now going back to our bank, and only $2,100 going to the condo and the house. Now, let me make sure you guys are following me here. Let me ask you a question. So far, we put into this policy $25,000 for 3 years for a total of $75,000. And we took loans out of the policy of $14,000, $16,000, and $25,000 for a total of $55,000. So how much is left in the policy? We put 75 in, we took 55 out. Put in the chat box, how much is left in the policy? What do you guys think? All right. Raul says 75,000. Teresa Wood says 75,000. What do you guys think? We put 25 in and pulled 55 out. Okay. Marlene, not 75 and 55, but it's not 20,000. It's not 60,000. It's 75,000. Because remember, we're putting the money into the policy. So the whole 75,000 is in there compounding and growing uninterrupted for us. And when we pulled that 55,000 out, 14, 16, and 25 each year, that came out in the form of a loan. So what we're doing is we're collateralizing our money over here, and we're letting that stay in the policy compounding, and we're borrowing the money from the insurance company's general account. That's what allows it to stay in there. So even though we pulled out $55,000 that we've deployed out to tackle the debt, and we're keeping that money paying off more and more debt each year, we still have, the $75,000 that's in there compounding and growing for us uninterrupted. So I love it. Those of you that got that right. And if you were right on with it, I love the way you guys are thinking, because you're already starting to think this way. So I'm doing a good job teaching you guys, right? So that's very, very good right there. All right. Year 4 of this policy. We put 75,000 in, over 26 available, recaptured payments of 44,000, 70,000 is used to pay down the condo. Now you'll notice we paid down the condo, but the monthly payments remain the same and everything else. Because with a mortgage, your monthly payments don't reduce or anything like that until it's completely paid off. So we had nothing that we could recapture there, but we did pay down the balance. So 5th year, same thing. We pay off the condo, the house. So we recapture that money. Now we only have 1,200 going to somebody else, and 4,500 that we recapture for ourselves. Now, in the 6th year of this policy, check out what happens. This first policy right here, the amount that they were able to put into it dropped a little bit. So when we build policies now, the amount of premium deposits that are going in annually into the policy, after around the 10th year, that amount's going to drop. In this policy right here, it happened in the 6th year. So the policy we design them usually happen in the 11th year. This one, it happened in the 6th year. But instead of 25,000, they were only able to put 10,000 in the policy. Now look what happens though. When they put 10,000 in, the policy grew by over 30%. They have over 13,000 to pull back out to use. So this policy is becoming very efficient, where when they put money into it, they have access to a lot more than they put in, right? But nonetheless, they were able to put $10,000 into this policy, and 13,000 of that 10 that they put in the 6th year is now available to pull back in the loan. But they wanted to start growing their banking system. So that first policy, because of MEC rules and regulations, is now capped at 10,000 a year going into it. Again, we'll see all this on your personal illustration, but for this one, 10,000 was available to go into it. So they wanted to be able to put more money in because they love the way that this works. So they started a second policy. You can't put more into the first one. So what do? You open more policies. So you can have essentially as many policies on yourself as you want. I mean, Brent has like 22 now. Chris has like 12 now. Devin has like 9 now. You just keep adding them as you grow financially to build your banking system. So that's exactly how that works. So this guy right here started a second policy with another 25 a year going in. So his first policy will hold 10, second policy, 25,000 going in, plus those recaptured payments. We take that $82,000 that we have and we pay off that house. So in 6 years, we were now able to eliminate all third-party debt from his financial life. And now those recaptured payments of $5,700 plus the 1,200, well, 4,500 plus the 1,200 is now going to be, how much was it again? 5,700. So it was $5,700 a month that was going to other people, all that interest. Remember that annual spending? All that interest that was going to other people is now going back to his and his family's bank and financial futures. And he'll continue to pay himself back all that interest and all that money until the cash value in his policy builds up. And then once it builds up, then he can start using that money to do what? Invest and grow wealth. Because as that money sits in the policy compounding uninterrupted, now he's pulling that money out not to pay off debt, not to buy more cars, but to invest and grow wealth. And that's where this comes really, really fun. And I'll talk just a little bit about that right now. We have a few more minutes to kind of get into that. But before I get there, this debt map, what I just showed you, how the chiropractor paid off that debt in 6 years instead of 19 years. We do this with all of our clients. So as soon as you're approved and your policy goes in force, you go right over to our mapping team. Our mapping team does a cash flow analysis with you. We teach you how to start using the policies, and we take your debt situation, we take your financial situation, and we create that exact same plan for you. So you can start doing this. And not only do we create it for you up front, but we meet with you every 3 to 4 months ongoing forever. For the life of you being a client with us, our mapping team is going to meet with you, and we're there for you on demand to help you to update your map, to check on things or how see how things are going. You know, if you have a financial hiccup or a challenge, you know, we'll help you redesign that to allow for that where we need to delay it or whatever the case is. But we're going to create this, what I like to call financial GPS. Where are you starting right now? Where are we trying to go? And let's create the fastest plan of action to get you from point A to point B in the quickest way possible. And when you start implementing these concepts and you have a plan and you have a strategy and you have a support team that's there helping you every step along the way, holding your hand, that's how you're going to create success and be able to take your financial life to the next level. It's not hard. You're not working any harder any longer, taking on more risk. We're just changing where this stuff goes, and we're your new team to help you do this stuff. So I want you guys to keep that in mind, you know, as you start to implement what I'm teaching you here tonight. So again, what if you don't have any bad debt, or what happens once it's paid off? What if you don't need to buy any new cars right now? Can you still benefit from privatized banking? Should you still become your own banker? And the answer obviously is hell yeah. That's what I'm telling you. That's where we can start building wealth and really start having fun, because building wealth becomes addicting. I mean, how many on you right here? Is anybody on right now? Has anybody done a private money loan through the private money club, and you start getting that mailbox money each month? You start getting those interest payments coming in each month. It becomes addicting. You start thinking to yourself, well, how do I do more of this? How can I do more investing? Or how many of you that are buying houses right now and flipping houses, you get that first check for $30,000, $40,000 after you do your first deal. You're like, well, how many of these deals can I do? Or wholesaling, you get those $5,000, $10,000 checks coming in. That's where it becomes friends. So we can store our wealth here and use the money to start, having fun with it and doing all these different strategies for building wealth. And this is all stuff we teach, real estate investors. And I'll get into this a little bit to show you guys a couple examples. But again, those of you that want to schedule calls with me, all you got to do is email me or text me your name and email. I'll send you back those bonuses, and I'll send you back my call calendar. So that way we can schedule a call so I can help you get started with all this stuff. Yeah. So Tess said, I love it so much. I just got my principal back a couple days ago, and we have another deal already in the works. Love it. Yeah, absolutely. That's awesome, Tess. Good job. And these are all different things that we can do, to build and grow wealth. All right, guys, remember there's 2 laws for creating wealth. Number 1, compounding interest. It's the 8th wonder of the world. Those who understand it use it. Those who don't pay it. Albert Einstein actually said that. And then let me ask you this. If compounding interest is so powerful, how about uninterrupted compounding interest for the rest of your life? That's what these policies do for you. Yeah, Brian, just email me or text me and I'll send that over to you, okay? I don't have anything to write your email down from this right now. And then number 2, law for creating wealth, money movement and flow. Money sitting still is losing money to inflation. Money in motion is making more money. So let's get that money out there moving for you. That's how we start eliminating things like inflation, and how you just don't have to worry about it. So this is an illustration of a policy I did for somebody a couple months ago, a 41-year-old lady. So something else we can do with this, keep this in mind. If you have a lump sum of money, if you have like a chunk of change sitting around, a lot of people right now have equity. They've cashed out of their homes, or they sold the stock, sold stocks at all-time highs, and now the money's just sitting, whatever the case might be, right? One of the things you can do is maybe you want to do 10,000 a year or 20,000 a year. In this case, she wanted to do 50,000 a year, but she also had another 100,000 sitting there. So one of the things we can do is what's called a dump in. So you can dump in a lump sum the first year of the policy and do a smaller amount annually moving forward. That's more manageable, but it gets the money in there. And the cool thing is with that dump in, you're going to be able to pull back out immediately, like over 90% of it. So in this case, she dumped in 100,000. She immediately had over 90,000 of that 100 to immediately pull back out to put to work. And in fact, the first year she puts 150,000 in, and look right there, the net cash value. She has 132,000 she can pull back out to use. So again, it's not quite 150, but very, very close. And now that 150 is in there compounding and growing every year for the rest of her life. She's only 41 years old. So that money's going to compound and grow for the next 50, 60, 70 years of her life. And then right here, you can see over here, this increase in net cash value. The second year, 50 goes in, grows by 48,000. Third year, 50 goes in, over 50,000. Fourth year, 50 goes in, over 53,000. I mean, look down here in the 11th year of this policy. She's 51 years old, puts in 17,000. Look at the policy. The growth is $45,000. She doesn't do anything. She just makes her deposit. Again, going back to what I said earlier about the banks. If you went to your bank right now and you deposited 17,000 and you knew immediately that your checking account balance was over 45,000 by depositing 17, wouldn't you get excited about depositing money in your bank? Well, this is what we do. This is why I get excited about depositing money annually into my policies. Because when I can deposit money, $17,000, and it grows by 50 grand immediately, well, what the hell are we waiting for, right? And that's what this does for you guys. So I just wanted to point that out right there. And we have lots of different examples. I mean, and we'll show you your illustration once you start the approval process. This was another one, $50,000 dump in and then $500 a month going in. This is how the money flows. You have your policy. This is that segregated bank account I was talking about. So when you take the loan from the policy, it goes into that segregated account. From there, in this case, they did a private money loan with the private money club. Now they have the monthly interest payments coming back from that loan that they did to the private lender or to the borrower. They have that monthly interest payments coming back in. Any of the money you're recapturing goes back into the policy, and all that profit right there is your spread. Remember, I was talking about the spread earlier. That money right there is the spread. That's money in your pocket. That's mailbox money. That's passive money that you're making for doing nothing. So here's one example of doing a private money loan. So again, their bank grew by $66,000 when they did a $48,000 injection in the 8th year of this policy. And then what they did is they took some of this cash value. They have $530,000 available. So in this case, they took a couple $100,000 and did a private money loan. So if I was to do a private money loan just out of my bank account at Wells Fargo, I would make 12%. But because I took the money from my banking policy, from my personal bank, not only did I make the 12% of the private money loan, but I also, my money within the bank grew 37% that month. So I paid 5% interest to use the money from the policy. So instead of a 12% return on my money, because I used money from my bank, I grew my money at 44%. So let me ask you this. How many would you rather make 44% returns on a private money loan as opposed to 12% returns? Everybody, right? We work no harder. We work no longer. We took on no more risk. We just took the money from our private bank as opposed to a traditional bank. That's it. No different. And that's what becoming your own banker is really all about. And again, we don't really talk about the death benefit. It's there. I mean, you guys saw it. I mean, look at the death benefit. Over $1 million, over $2 million. So we don't talk about that stuff, but it's there. I didn't have time to show you how you can use this in your business. Those of you that have businesses, own businesses, how you can borrow money from your individual policies, lend it to your business, create tax deductions, fund the business, whatever you need. There's so many different uses for this. The kids policies, I briefly mentioned that, but kids policies are just amazing. Kevin, to set up one of these policies, just email me or text me. We'll schedule a call. I'll hop on the phone and I'll start helping you set it up right then. There's no cost either, guys. You're never going to pay me $1. I do all this for free. Not for free. The insurance company pays me a direct commission for bringing them the business, but you personally will never give me a dime. I'll do as many consultations as you need, as many strategies as you need, calls. I'll hop on the phone as many times as you need to make sure you fully understand everything. Our applications team helps you get approved. Our mapping team gives you all the ongoing support. I'm literally available anytime. I mean, that's my personal cell phone right there. People text me, people call me all the time. So it's no big deal. Don't call the text, but yeah. So email me or text me and I will send you over the calendar, Kevin, so we can set up a call so I can get you banking just like everybody else. Warren Buffett said it best. If poor people would just do what rich people do, they won't be poor anymore. Kind of funny, but Warren Buffett has a fine way of simplifying things. So ask yourself two things if you were sat here and watched this right now. Are you better off with this while you're alive? Are you better off with or without it? And are you better off with or without this when you pass away? And I think here this evening, I just proved to you in both cases, you're much better off with this alive as well as when you pass away. So if you guys like what you heard, again, text me, email me, let's schedule that call and let's get things rolling. So it looks like I have 2 questions on here. I'll answer real fast. For someone in their late 40s with no policy yet, is it still possible to make this happen? Yes, Samuel, absolutely. I'm helping somebody right now get approved for a policy that's 71 years old. No problem in your 40s. That's a great time to get started, actually. Rick said, how do you make your money on these deals? So again, we get a direct commission from the insurance company, if that's what you're asking, Rick. All right, guys. Well, it's all the questions I see. So if you do have any other questions or need anything, just shoot me an email or a text message. We can schedule a call, hop on, and let's get you guys banking. So thanks so much for being here. We're going to stop the recording, stop the share. And we'll see you guys, like I said, tomorrow on our wealth webinar series. We do WTF every Wednesday morning at 9:30 Eastern. We do all kinds of financial strategies and planning and stuff like that on our wealth webinar every Wednesday at 1 p.m. Eastern. We do a business building and precious metals webinar every Thursday at 3 p.m. Eastern. So these are all free webinars. Money Club Mondays every Monday at 1 p.m. So make sure you join us for the other webinars as well. If you like this tonight, you want to hop on again and watch it again, I will be doing it next Tuesday at 6 p.m. Eastern. And feel free to invite other people too. You can invite friends, invite family to these. More than happy to share with them as well to any other webinars. So if you guys text me and email me, I'll send you my call link. I'll send you the digital bonuses, those 2 books free of charge. And I'll send you a schedule for all the other webinars that we do as well. So Monica, just email me and text me, and I will send all of that stuff to you. The schedules for the other webinars, you can share it with people and all that good stuff. So I appreciate you guys being here. Look forward to working with you. If you need anything, give me a shout. Have a great evening. Hopefully you guys all had a great Memorial Day, and we'll talk to you very, very soon. Thank you.